Greetings and welcome to the Titan Machinery, Inc. Fourth Quarter Fiscal 2026 Earnings Call. At this time, all participants are in a listen-only mode. A question-and-answer session will follow the formal presentation. If anyone should require operator assistance, please press star zero on your telephone keypad. It is now my pleasure to introduce your host, Jeff Sonic of ICR. Thank you. You may begin.
Thank you. Welcome to the Titan Machinery Fourth Quarter Fiscal 2026 Earnings Conference Call. On the call today from the company are Bryan Knutson, President and Chief Executive Officer, and Bo Larson, Chief Financial Officer. By now, everyone should have access to the earnings release for the fiscal fourth quarter and full year ended January 31st, 2026. If you have not received the release, it's available on the Investor Relations tab of Titan's website at ir.titanmachinery.com. This call is being webcast, and a replay will be available on the company's website as well. In addition, we're providing a presentation to accompany today's prepared remarks, which can be found on Titan's website at ir.titanmachinery.com. The presentation is directly below the webcast information in the middle of the page. We'd like to remind everyone that the prepared remarks contain forward-looking statements, and management may make additional forward-looking statements in response to your questions. The statements do not guarantee future performance, and therefore undue reliance should not be placed upon them. These forward-looking statements are based on current expectations of management and involve inherent risks and uncertainties, including those identified in today's earnings release and presentation, and in the Risk Factors section and other portions of Titan's reports filed with the SEC. These risk factors contain a more detailed discussion of the factors that could cause actual results to differ materially from those projected in any forward-looking statements. Except as may be required by applicable law, Titan assumes no obligation to update any forward-looking statements that may be made in today's release or call. Please note that during today's call, we may discuss non-GAAP financial measures, including results on an adjusted basis. We believe these adjusted financial measures can facilitate a more complete analysis and greater transparency into Titan's ongoing financial performance, particularly when comparing underlying results from period to period. We have included reconciliations of these non-GAAP financial measures to their most directly comparable GAAP financial measures in today's release. At the conclusion of our prepared remarks, we'll open the call to take your questions. And with that, I'd now like to introduce the company's President and CEO, Mr. Bryan Knutson. Please go ahead, Bryan.
Thank you, Jeff, and good morning to everyone on the call. I'll start today with an update on our inventory optimization progress and operational focus areas, and then discuss the current environment across our segments before turning the call over to Bo for his financial review and comments on our fiscal 2027 modeling assumptions. Fiscal 2026 was a year where our team executed at a high level in a difficult environment. For the full fiscal year, we reduced total inventory by more than $200 million, surpassing our $100 million target that we announced at the beginning of our fiscal year and our updated $150 million target we revised last quarter. Our inventory peaked in the second quarter of fiscal 2025 due to the heavy influx of equipment shipments as supply chains normalized post-pandemic. And since that time, we've reduced total inventory by $625 million over this 18-month period. I'm extremely proud of the disciplined work our team has done across all of our locations to make that happen in what continues to be a very challenging demand environment. This progress illustrates our intense focus on creating a more resilient enterprise and positions us well for strong results when market conditions improve. Importantly, the quality of our inventory has improved meaningfully. It is leaner, it is fresher, and it has a better mix of in-demand categories. But we are not done. We still have work to do across certain used equipment categories and some of our slower-moving seasonal new equipment categories. As we head into fiscal 2027, our focus shifts from inventory reduction toward product mix optimization as we look to continue to improve inventory turns through minimizing aged inventory and thus decreasing interest expense. Our customer care initiative remains central to our operating strategy and continues to demonstrate its value while at the bottom of the equipment cycle. Our parts and service businesses are currently generating over half of our gross profit dollars, providing critical stability in these tough times our industry is currently facing. Our customer care initiative keeps us closely engaged with our customers, allowing us to add value to their operations and positioning us well for when equipment demand eventually recovers. With our hard work and dedication to superior customer service, we expect stability in our parts and service business in fiscal 2027, despite another expected decline in equipment industry volume in North America. With that, I will turn to our segments. In domestic ag, the environment continues to be very challenging for our grower customers ahead of the upcoming planting season. Our OEM partners are calling this year the trough of the cycle, and the guidance we are providing today reflects that. Commodity prices remain well below break-even for most growers, which continues to be the fundamental issue facing the industry. When you add in persistently high interest expense, increased input costs, and limited government support, we expect many growers to remain conservative in 2027 in terms of their equipment purchasing decisions. With respect to potential government support, seeing E15 passed into law is currently our customers' biggest priority, followed by further adoption of biodiesel and sustainable aviation fuel, or SAF. Allowing E15 usage year-round would help alleviate the ongoing oversupply of corn and assist with energy independence. Furthermore, recent spikes in diesel prices highlight the need for increased production of domestic biodiesel. In construction, infrastructure and data center work continues to provide a solid baseline of activity, but residential demand remains softer. Many of our customers are cautiously optimistic as they look at their schedules for the year ahead. Despite the mixed outlook in the end markets we serve, we remain optimistic about the long-term fundamentals of this business, which is underpinned by ongoing housing shortages, infrastructure spending, and continued data center construction. In Australia, the market conditions have been similar to what we are seeing domestically, but exacerbated by elevated input costs for diesel fuel and urea. However, after 2 years of historically low industry volumes, we are starting to see some more encouraging signs, and recent rainfall has helped improve soil conditions and farmer sentiment after an extended period of dry weather. Overall, our expectations are for modest industry volume growth in fiscal 2027. We continue to like our position in Australia. It is a major agricultural export market with strong fundamentals, and our dual brand strategy with Case IH in New Holland, which is now available in 6 of our 15 rooftops, gives us more reach and more ways to serve our customers across our footprint. In Europe, we are pleased to have the majority of our German divestiture behind us, with some remaining wind-down activities carrying into the first quarter. As we head into the spring planting season in our Eastern European markets, we are cautiously optimistic that we will see modest improvement in industry volumes coming off of trough levels, but expect them to remain well below historical averages in Romania and Bulgaria. The modest overall industry volume growth should partially offset an expected year-over-year decline given the normalization of our Romanian business, which had an exceptionally strong prior year driven by the EU subvention programs. In closing, I want to express my sincere appreciation to our entire team. We dramatically surpassed our inventory reduction goals and made meaningful improvements to our operations, and we did it while maintaining the exceptional customer service that differentiates us in the market. Our team's focus and dedication throughout this year is what made our successes possible. We are executing on our initiatives, managing what we can control, and positioning the business to perform well as market conditions improve. With the actions we've taken thus far, We will emerge from this period a stronger company. With that, I will turn the call over to Bo for his financial review.
Thanks, Brian, and good morning, everyone. Starting with our consolidated results for the fiscal 2026 fourth quarter. Total revenue was $641.8 million, compared to $759.9 million in the prior year period, reflecting a 14.6% decrease in same-store sales driven by weaker demand in our domestic ag, construction, and Europe segments, partially offset by growth in our Australia segment. Gross profit for the fourth quarter was $87 million, compared to $51 million in the prior year period, and gross profit margin was 13.5%, approximately double last year's rate. The year-over-year improvement primarily reflects the lapsing of inventory impairments and other inventory reduction efforts in the fourth quarter of the prior year that significantly compressed equipment margins. Equipment margins in the fiscal 2026 fourth quarter continued to face pressure from softer retail demand and remaining aged inventory. However, margins have improved as inventory has returned toward healthier levels. This equipment margin improvement is expected to continue in fiscal 2027. Operating expenses were $95.7 million for the fourth quarter of fiscal 2026, down slightly from the prior year period. Our headcount and discretionary spending continues to be down year over year as a result of disciplined expense management. Floor plan and other interest expense was $9.6 million, representing a decrease of approximately 27% on a year-over-year basis and a decrease of 13% on a sequential basis. This progress reflects the significant reduction in interest-bearing inventory levels over the past year. In the fourth quarter, net loss was $36.2 million, with loss per diluted share of $1.59. Which includes the recognition of a 78-cent non-cash valuation allowance that resulted in an increase in income tax expense. Importantly, I'd note that this allowance was greater than our initial expectation, which called for a 35 to 45-cent headwind that was built into our adjusted EPS guidance on the third quarter call. Big picture, it is non-cash and does not impact our operating performance or our cash flows. However, it is an important variable influencing our reported results versus the expectations we set. Hence my emphasis to ensure the linkage is clear. Adjusted net loss, which excludes charges related to our German divestiture and related wind-down activities, but includes recognition of the $17.8 million non-cash valuation allowance I just mentioned, was $32.5 million, or a loss of $1.43 per diluted share. This compares to last year's fourth quarter adjusted net loss of $44.9 million, or $1.98 per diluted share. To summarize, our underlying revenue and profitability was in line with what we had expected, as evidenced by looking at our pre-tax loss, which in addition to being consistent with our expectations, has improved significantly versus the prior year period. Now turning to a brief overview of our segment results for the fourth quarter. Our domestic agriculture segment realized sales of $406.7 million, reflecting a same-store sales decline of 22.8%. Driven by continued softening in equipment demand as a result of weak grower profitability. Segment pre-tax loss improved to $9.9 million compared to adjusted pre-tax loss of $56.3 million in the fourth quarter of the prior year, reflecting the actions we have taken to accelerate inventory reductions and the resulting improvement that we have achieved over the past 12 months. In our construction segment, same-store sales decreased 4.6% to $90.2 million, driven by lower equipment sales. Our inventory reduction initiatives have weighed on equipment margins in this segment as well. Adjusted pre-tax loss was $1 million compared to a $1.1 million loss in the fourth quarter of the prior year. In our Europe segment, sales increased 5.2% to $68.8 million, which included a $4.3 million net benefit related to foreign currency fluctuations. On a constant currency basis, revenue was more or less flat year-over-year, reflecting the normalization of demand following the EU subvention fund-driven strength, which ended in the third quarter of this year. Pre-tax income for the segment was $1.8 million compared to a pre-tax loss of $1.8 million in the fourth quarter of the prior year. Excluding restructuring and impairment charges associated with the Germany divestiture, adjusted pre-tax income was $5.4 million in this year's fourth quarter. In our Australia segment, sales increased 16.7% to $76.1 million, compared to $65.3 million in the fourth quarter last year, including a negligible foreign currency impact. Pre-tax income for the fourth quarter of fiscal 2026 was $2.5 million, compared to $2.3 million last year. Now, briefly summarizing our full year fiscal 2026 results. Total revenue was $2.4 billion for fiscal 2026, compared to $2.7 billion for fiscal 2025. Adjusted net loss for fiscal 2026 was $50.6 million, or $2.22 loss per diluted share, which includes the non-cash valuation allowance, but excludes the charges related to the Germany divestiture I discussed earlier. This compares to an adjusted prior year net loss of $29.7 million, or $1.31 loss per diluted share. Now on to our balance sheet and inventory position. We had cash of $28 million and an adjusted debt to tangible net worth ratio of 1.7 times as of January 31st, 2026, which remains well below our bank covenant of 3.5 times. For the full fiscal year, total equipment inventory decreased by $201 million to $725 million. As Brian described, this more than doubled our $100 million target for the year. It is a meaningful accomplishment in this environment, and it positions us well heading into fiscal 2027. Importantly, as part of that inventory reduction, we saw a significant improvement in the amount of aged equipment we have on our lots. Aged equipment, which we consider to be equipment that we have had for longer than 12 months, peaked in the second quarter of fiscal 2026 and declined by approximately 45% to $174 million in the second half of this fiscal year. This improvement in the health of our inventories has started to show up in higher equipment margins in the back half of the fiscal year. But we still have work to do on reducing the amount of aged equipment we have, and we are confident we'll continue to make progress on that in fiscal 2027. With that, I'll finish by sharing our initial outlook for fiscal 2027, starting with our top-line modeling assumptions across our segments. For the domestic ag segment, we expect revenue to be down in the range of 15 to 20%, which is consistent with the depressed cash crop industry outlook we've discussed today. Looking ahead, we believe we are back in sync with broader industry dynamics following our aggressive inventory reduction activity over the last year and a half. The construction segment is expected to be in the range of flat to up 5%, which aligns to the more favorable industry fundamentals that are benefiting from infrastructure and other sector-specific tailwinds. Our European segment is expected to be down in the range of 20 to 25%. This decline reflects our exit from Germany, which contributed approximately $50 million of revenue this past year, and reflects the normalization of sales in Romania following the strong performance in fiscal 2025. As a reminder, this segment grew 45% in fiscal 2026. Excluding this difficult comparison, we expect modest improvements in industry volumes off cyclical lows, but the Eastern European market remains challenged by the same broader ag cycle dynamics as our domestic ag business. For our Australia segment, we expect revenue to be up in the range of 10 to 15%. This growth includes activity from the acquisition we completed last fall, and the modest improvement in industry volumes that Brian previously mentioned. From a margin perspective, our fiscal 27 assumptions consider consolidated full-year equipment margin to be approximately 8.4%, which compares to fiscal 26's full-year consolidated equipment margin of 7.3%. This margin assumption reflects improved inventory health, but still factors in the need to finish driving down aged inventory. And it also reflects broader industry expectations that North America industry volumes will be down 15 to 20%, which implies the lowest level since the 1970s. Given that context, we are happy with how well we are positioned to manage through the trough and confident we'll return to normalized equipment margin levels as industry conditions improve. Operating expense dollars are expected to decrease year over year, although we'll continue to invest in our customer care strategy, which is supporting stability in our parts and service businesses. And overall, operating expenses are expected to be approximately 17% of sales. Floor plan interest expense is expected to decline by approximately 25%, following the significant inventory reduction that we achieved last year. In absolute terms, interest expense will continue to decline as we further reduce aged inventory throughout the year. Bringing it all together, we are introducing a fiscal 27 modeling assumption range of an adjusted loss of $1.25 to $1.75, which compares to the $2.22 adjusted loss we realized in fiscal 26. It is worth noting that given the U.S. tax valuation allowance that was booked this quarter, we will have a very low tax rate for fiscal 2027, with most of the tax expense and/or benefit being recognized in our international segments. We also thought it would be helpful to provide some specific below-the-line expectations in our press release to help bridge to our adjusted EPS outlook. Further, we have also added adjusted EBITDA to our outlook to help provide a clear view of the operating performance we are achieving today, and as we look into the future as the cycle unfolds. So, we are also guiding to adjusted EBITDA in the range of $17 to $29 million, which compares to the $13.9 million we generated in fiscal 26. In summary, despite the expectation for historically low industry volumes for our domestic ag segment, we are positioned to benefit from the aggressive inventory reduction posture we have taken over the last couple of years. Thematically, this positions us to improve margins this fiscal year and begin building back our earnings power at an accelerated pace as the cycle eventually turns back in our favor. For the time being, we continue to set prudent expectations and look forward to demonstrating our execution in the quarters ahead. This concludes our prepared comments. Operator, we are now ready for the question and answer session of our call.
Thank you. We will now be conducting a question and answer session. If you would like to ask a question, please press star 1 on your telephone keypad. A confirmation tone will indicate your line is in the question queue. You may press star 2 to remove yourself from the queue. For participants using speaker equipment, it may be necessary to pick up the handset before pressing the star keys. One moment please while we poll for questions. Our first question comes from the line of Liam Burke with B. Riley Securities. Please proceed with your question.
Thank you. Good morning, Brian. Good morning, Bob.
Morning.
We were looking at a best case in the corn pricing of about $5. It's inching up there. It's improving directionally, not at $5 yet, obviously, but is there any movement by the farmer community to start getting interested in loosening the purse strings, or does it have to be a 5 and above where everybody gets comfortable on the equipment purchases?
Yeah, there's definitely been some upside here in the last week or two in the market, so that's been positive to see. Like you said, for a lot of growers, we're still below break even at these levels, and then you just take some of the uncertainty as well. So plausibly somewhere between another 50 cents and a buck on corn here, which with certain fundamentals coming together, looks like there is a possibility for at this point. So that too looks more optimistic than even a month ago. So we'll see where that tracks, and then just consistency as well. At this point with the long-term fundamentals that are in place, the current supply and demand and the oversupply we have of corn and soybeans directionally, they're looking at, just a short-term spike doesn't give them a lot of confidence, but as things progress here and if the conflict continues on and we see increased stability there and again prices uptick further, that definitely will help confidence, and that's something that we're monitoring closely. We've also been to D.C. quite a bit in the last year, lobbying for our farmers and trying to do what we can for commodity prices. We'll be there again next week. Friday, March 27th next week, there's a celebration of Agriculture Day at the White House that we're looking forward to. And as we get near the end of the month here, there should be some stuff coming out with the RVOs, and we've been really pushing for E15, passing that into law and greater adoption, and all the benefits that could come with that for, reducing prices at the pump as well as just energy independence and again, helping alleviate some of the ongoing oversupply of corn.
Great, thank you. And understanding that the timing of an upcycle is difficult to predict, but you're comfortable in some future upcycle that you're sized right to maximize the leverage in how the business is run? Obviously, you've been managing for the down cycle, but you're in a position to maximize the upside leverage?
Yeah, absolutely. I mean, as we stand here today, we're excited as we look forward. Just for a little bit of context in terms of the guidance for this year, North America industry volume down 15 to 20%. What does that really mean? Well, calendar year 25, the year that just ended, industry volume on the major categories that help drive our business was already 10% lower than the trough in calendar years 15 and 16. And so this year, if you assume that down 15 to 20, we're talking about industry volume 25% lower than the prior trough. So as we stand here, as well positioned as we are, obviously we want the P&L to reflect more, but extremely confident in terms of how quickly that can turn around and really flexing our muscle on the upside as things improve even modestly in the right direction. So for sure, everything we've been working towards the last 2 years isn't just about managing the downside, but it's about making sure that we're running things ready for when things do turn around. All of our efforts on customer care strategy, driving the parts and service business, how do we support customers well, how do we gain maximum share of wallet by delivering what they need. All of that stuff is coming along, and I can appreciate that it's not necessarily something that you or investors get to see every day. But we just get more and more confidence and more excitement about the team we have, the playbook that we've been executing, and how well positioned we are to really kind of show our strength as ultimately growers get support in the right direction and they see improved profitability.
Great, thank you.
Thank you. Our next question comes from the line of Ted Jackson with Northland Securities. Please proceed with your questions.
Thanks very much. I got a few. I'm going to start with the bigger one and then some that are just more around the model. On the larger, in terms of the guidance that you've set, I'm curious with regards to what's baked into it, rather than just, the OEM guidance itself. I mean, are you assuming that China comes in and honors its commitments to buy more beans as we roll through 27? And is there anything baked into it with regards to E15 or the aviation fuel? That's my first question.
Yeah, thanks, Ted. Yeah, so generally speaking, what we do have baked in is that China essentially honors the commitments that have been put out there. not materially any more or less than that. Certainly, if they did come to the table with more, that would help. And then nothing on E15, so certainly that would be a shot in the arm and upside to what we've guided.
Mm-hmm. And then just another one kind of at a macro level, with the war we have with Iran, which is, now we're into several weeks of it. Have you noticed any perceived shift in terms of sentiment within your territories with regards to that? I mean, all I get is stuff out of the paper, and I live in a pretty left-leaning local paper environment. So most of what I get is pretty negative with regards to the farmer. But is the farmer feeling anything in terms of impact at this point with regards to higher fertilizer prices, diesel prices? I mean, we're not even in the planting season. I mean, has there been some kind of shift, some kind of additional concern? Just a little color there.
Yeah, certainly a few moving pieces there, and even differences from our U.S. farmers to our Australian farmers. So just looking at some of the routes, through the Strait of Hormuz there, and you look at like that's impacting fertilizer and fuel prices even more for our Australian customers. Still able to get it, but certainly a delayed and elevated pricing, and then similar impacts to Europe and then the U.S. there. So those are some additional increases to input costs, which are already high. You look at over the years here, fertilizer has been the input that's generally gone up the most and has the most impact on their P&L. And so with that becoming harder to get here and increasing further is also a negative. But overall, actually, as the corn market and other commodities tick up here and kind of follow along with the price of crude, that has an opportunity to be a positive as that expands and maybe potentially here outpaces the increase in inputs, which is certainly a likely scenario. So there's definitely a number of things in play there, Ted, but a scenario where it actually is likely potentially more positive for our growers.
Would you think it'd be neutral and it may be more positive? But it seems like your view is at worst it's a net.
Yeah, I think it depends how long it lingers on and what happens with the commodity markets. It does start to spread a bit. So as corn goes to, if corn were to go to 6 and then it lingered on further and potentially to 7 as an example, it starts to pull away from what the increase in fertilizer prices has been, especially for a lot of our growers here in the U.S. and the Midwest. They pre-buy a good chunk of their fertilizer, so it could end up being more of a 27 calendar year impact for them on that. So again, there's as weird as it sounds, there's some upside potential there depending on how this plays out for our growers.
Okay. And then just a couple model questions, and I'll let other people take over. Bo, I was curious what the view was for CapEx for 2027, and then maybe a discussion about tax rate, given all the kind of moving parts in there, either at a rate, that percentage rate or something around a dollar amount.
Yeah. So first for CapEx, I mean, in this environment, as you would imagine, being prudent, pretty prudent there and pulling back. So excluding any investment in rental fleet, which kind of comes in and out, we're guiding to about $15 million of CapEx, really just pulling back in prudent levels there, a little bit on facility and some vehicles, for example, but smaller than I would say would be typical. From a tax rate perspective, there could certainly, as a general statement, the tax rate in the U.S. is expected to be near zero. There will be a little bit of noise there with some deferred, but essentially the valuation allowance is largely wiping that out. And given the significance of the U.S. to the rest of it, right, it really drags the whole thing down near zero. So on the release, we had guided to a range of $0 to $1 million of total tax expense. From an Australia perspective, no real noise there. You can think about their rate in that 30% range. And then from a Europe perspective, again, what their blended rate in the high teens, that's what I would expect. Balancing all out, a lot of this stuff is netting down close to 0 would be our expectation for the year. One more thing on that too, I guess, just to make it clear, the need for evaluation allowance is kind of an established standard that's been out there in terms of a 3-year rolling loss. We went through the same thing in the last downturn, put on evaluation allowance, and a couple of years later took it off. The cyclicality of our business, and especially from a dealer P&L perspective, some could certainly argue that this 3-year rule isn't necessarily accomplishing what it's trying to. And long story short, all I'm trying to say is high degree of confidence that a couple of years later we're going to take that back off and you're going to see a big positive, which of course we'll call out is releasing the valuation allowance.
Okay, thanks for the answers. I'll get out of line.
Thank you. As a reminder, if anyone has any questions, you may press star 1 on your telephone keypad to join the queue. Our next question comes from the line of Ted Jackson with Northland Securities. Please proceed with your question.
Dang, I own you guys. Well, let's talk about some sports then. No, a couple other questions for you, Bo, just around the model. So again, depreciation and amortization, and then the impairment charges. Can you give some kind of color of what you see that rolling through in 2027? And then over on OpEx, when I think about OpEx, you're going to have OpEx down, you're going to have investments though in some other things. So I assume the down is on sales commissions given the volumes, but maybe talk a little bit about how, as you think about sales, typically I've kind of thought about it as your sales portion of your OpEx, your selling commission being about 25% of equipment gross margin. Would that kind of assumption still hold as we think about 26, or given the weak volumes, are you going to have to kind of, make up a little bit to make sure those guys get a living wage? Those are my next two questions.
Yeah, so recently, I'll break those into pieces. You'll have to remind me if I forget one. I'll start on the commission side of things. Recently, our commissions has been north of that 25% mark. In a healthy environment with normal margins, it's in that 25%. So I'd say we're coming down closer to the 25%. We've been elevated above that, but kind of normalizing here as our margins are coming up. So that's how I would think about that from a commission perspective. Just broadly on OpEx. And again, this isn't just something that changes in a month. We've been at this now over the last couple of years as we've looked at where the industry has been going and what we've needed to do. And largely speaking, the rest of our OpEx is people, and it's our people that are helping support our customers. So we've managed headcount down prudently. But back to the question that kind of started all of you guys positioned for when things turn around, and that's the balance that you have to strike. We've got a great team that supports our customers well across our entire footprint and all of our geographies, and just managing prudently down as much as we can, but without overdoing it. That's kind of the balance we've struck. So that drives a lot of the decline in OpEx there. So from a 17% perspective, in absolute dollar terms, I feel good about the work we've done. The 17% is more reflective of the pullback we're expecting here in North America Ag. Remind me where we started here. You had two others.
Yeah, I'd ask just about kind of just thinking in 2027, how to think about depreciation and amortization as we're driving through, towards our EBITDA numbers. And then, it's just been, for the last several quarters, a lot of impairment charges rolling through. Are we going to continue to see that through 27, or is that going to die back?
Yeah, good question. So a good portion of the impairment charges were specifically related to the Germany divestiture and wind down activities. There's a small amount of Germany activity left here this year. I don't expect it'll be a negligible P&L impact. And then from other impairments, I would say expecting that to be a little bit lower as well. I mean, south of $2 million in total is kind of the thought process there. just as you're looking at your normal, impairment analyses based on where you're at from an industry perspective. So yeah, I guess relief in that regard. And then, sorry, there's one other one here. What did you say before that?
No, I just kind of asked since I had you, and it seems like it's my Q&A. Just kind of decided I'd ask what you thought depreciation amortization might be.
Oh yeah. Yep. Sorry about that. So depreciation and amortization has been kind of in the mid-30s, $35 million-ish. Expecting it to come down slightly. Really not changing drastically there.
And then the impairment, just to make sure I understand, when I think about 27, aggregate across the year, you see like a continued amount of small impairment charges of roughly $2 million across the whole year.
Yeah, and that's really fairly similar to what this year was ex-Germany activity as well. So not much there.
Okay. If I'd known I was the only guy getting Q&A, I would have put more effort into pre-writing my questions. So.
Okay, well, one thing, just taking the opportunity for the broader audience and all of the analysts covering us, across our sales mix by geography, so Ag down 15 to 20, CE flat to up 5, Europe down 20 to 25, Australia up 10 to 15. Blended average wise, midpoint of the guidance implies revenue down 14 to 15%. But I would say, as we've thought about it, and it's certainly not a perfect science quarter to quarter, I'm thinking more Q1 down like 20-ish% and Q2, Q3, Q4 somewhere in the down 12, 13% range. That gets you to the full year. So in other words, Q1 comp down sharper, and just wanted to call that out so people work that into their expectations. If you think about just how the cadence of last year was, first half had about 47% of our revenue, whereas historically it's about 45%, right? And that was just the theme of last year and kind of softening as we went through the year. So normalizing that a bit, just wanted to put that out there.
Hey, that does bring up one kind of just a little tiny question. You typically do have a stronger fourth quarter. You did have one this year. I'd assume most of it this year was less about farmers coming in, flush and buying, and more about, tighten, trying to push off inventory in your efforts to, take your working capital to where you want it to be. So one, is am I correct with that? And then two, is as I think about 2027, I mean, we are going to be at a point where, I would imagine by the time we exit the year, recovery or not, your inventories are going to be aligned. The trough is, well beyond a typical, trough of a cycle. Do you see in the fourth quarter of this year, and you're going to have, more of an impact with regards to some of the things with the Big Beautiful Bill, that you would see a little bit more of a flush from the farmer in the fourth quarter of 27. So those are my two. It's kind of a little color maybe on 26 and how you think about 27 in the fourth quarter. And then I will get out of the line.
Yeah, as you pointed out, Ted, in Q4, again, I just give a tremendous compliments to our team and the disciplined execution that we did. When we came out at the beginning of the year with our $100 million inventory reduction target, that was an extremely lofty goal, and our team more than doubled that reduction. That was due to our efforts and, really boots on the ground and creative marketing campaigns and pulling growers off the sidelines and getting rid of that excess inventory. So, great execution, and like you said, that wasn't just farmers coming in Q4 and looking to purchase. So, and then as we, that does again position us tremendously well. Again, I think you hear that confidence for how good we feel about where our business is positioned right now. We've got a little bit of cleanup yet to do in a few select use categories and some certain select seasonal new equipment categories. We'll work through that here throughout this year, but that's really fine tuning. Every dealer I've ever seen always has a mix of that in any economy. So we're just going beyond even what we normally would do. We're just getting into an extremely healthy state here. So we're positioned when this does uptick, and we've done many of the things internally, very stringent cost controls and expense reductions, as Bo pointed out. And we'll stay lean here, and then, as it recovers, which at some point it will, as we talked about, the replacement demand just continues to grow here, and just waiting for that uptick in profitability for our growers, as it depends on the commodity prices, and again how that ties back to the supply and demand ratios, and then our cattle producers, livestock producers, are still sitting quite well, and we look forward to that continuing. The more years that they do well, the more they'll start to spend. So there's certainly potential there. And then the fundamentals in construction. There's a big data center that has been going on here for a while, 2 hours south of our office, or an hour and a half here. Another one going up right in Fargo that's starting here, a $3 billion data center. And again, throughout our Midwest footprint. So, and then just overall, some of the things with infrastructure and at some point here, we've got to address the residential housing shortage. So that's also a good long-term fundamental for construction. So there's a lot of good fundamentals in play here. Again, we'll see what happens with the commodity prices and with the RVOs here, especially, and potentially, as I mentioned, as soon as the end of March here, E15 is a great opportunity for our country, and it's right there, and it would really help alleviate this oversupply. And if we address some fertilizer constraint and pricing issues, which again through further research and development and some other things could help with, and then the table's really set. I mean, the American grower can raise a lot of corn if given the opportunity, and we can supply the world a lot of corn and beans and other commodities, and the way the equipment's advancing, how professional our growers are looking, the stage is set very well here. And as we go into 27, our company is never going to have been positioned better.
One more thing real quick, just from a Q4 perspective. Q4 is a big pre-sale quarter, and it was last year as well. So a lot of equipment that was being delivered was deals that were being discussed in the summer and early fall. So I'd point to the same thing here. This summer and early fall will really set the stage for what the end of the year looks like. Obviously, there can be some incremental buying at the end of the year, and there always is. But that's a big one. We set prudent expectations based on where the market's at today. Brian mentioned several factors. We've talked about several factors today that could move it, north of that. But we've set expectations based on what has materialized thus far. But, as usual for every year here, as we really get into the summer and we see what that pre-sale looks like, we work with OEMs to really see where the market is. That'll set the stage more for what the back end of the year looks like.
Okay. Thanks for everything.
Thanks.
Thank you. And we have reached the end of the question and answer session. Therefore, I'll now turn the call back over to management for closing remarks.
Again, I just want to thank our team for their buy-in and tremendous execution and discipline to make the hard decisions and put forth all the effort they did to position us where we are today. And I thank everybody on the call for your participation and look forward to updating you next quarter on our results.
Thank you. And this concludes today's conference, and you may disconnect your line at this time. Thank you for your participation. Have a great day.